issues and concerns. I call upon Dr. Manoranjan Sharma to take over the session.
Sir, sir, please unmute your mic.
Hi, is this okay now?
Yes, sir. Yes, sir.
Okay, thank you very much, Professor Vidyaran. We now begin with the first technical session. So what I would propose to do here is to highlight some generic issues in a cross-country framework, get the Indian experience of mergers and acquisitions in the banking sector, and the roadmap ahead. First of all, let us begin with the issue, why consolidation? This is a basic question. Why should we go in for consolidation? Now, there are several important forces and factors driving consolidation in India. These relate to globalization of financial markets, intensified competition in the financial sector, rapid growth of international trade, banks abroad pursuing activities prohibited in the home country, and the distinct opportunity of tapping overseas euro, dollar, and other markets. This process of increasing consolidation in the banking sector, greater degree of mergers and acquisition has also received some kind of an impetus by the relaxation of historical restrictions on both interstate and intrastate banking. Some of the important regulations in this context refer to the Graham-Leach-Bailey Act of 1999. In this kind of a setting, consolidation primarily emerged to leverage benefits of large size, expanding and diversifying bank loan portfolios to reduce failure and harnessing core competencies. Now, we have done some kind of a study on the basis of important work done by leading universities, research institutions, also by some consultancy organizations all over the world. And in the last 10 years, we find that the process of consolidation in banks at the global level has gained a sharper focus because of what we call the next normal. In this next normal, there is a greater thrust on digital banking channels. In India, we find that this has received an accent because of the triple whammy of demonetization, the rolling out of the goods and services tax, and finally the COVID-19 pandemic. At the global level, also to a certain extent in India, what you find is that there has been some kind of a major disruption by non-traditional players. For example, fintechs, e-retailers, other big non-banking technology companies, private equity players. Some important work has also been done in the World Economic Forum, WEF, and they have done some kind of a cross-country study. Some of you may be aware that as per the IMF World Bank data set, there are roughly about 200 countries in the world. And they have tried to look at the future, gazing into the crystal ball, and they find that in the next decade or so, 10 industries they have isolated and identified which are likely to be severely disrupted. And the financial sector industries, banking sector industry is one of the top 3 or 4 industries likely to be disrupted. And when we say disrupted, we say disruptive not in the sense of incremental changes, but far-reaching, game-changer changes, breakthrough changes. In fact, the magnitude and the gravity of the changes have been so huge and humongous that it is sometimes maintained. I think the original sentence, a very catchy phrase, goes to WEF, World Economic Forum, is that banking will certainly remain in the foreseeable future, but whether banks will remain or not is a matter of some debate or discussion. So this is the magnitude of the kind of sweeping changes we see in the world all around us. Basically, what we find is that there are four thematic patterns emerging in consolidation all over the world. One of obviously is the consolidation for scale. The second pattern is core portfolio optimization through divestment of non-differentiating assets to solidify, to strengthen balance sheets, increasing targeted portfolio investments. There is also a greater thrust on new capabilities, partnership, for example, with fintechs to maintain or regain innovative momentum. And there is a much greater thrust on building the right kind of ecosystems through acquisitions, alliances, joint ventures to broaden the horizon of value creating opportunities. Now, on the basis of very important studies done by different leading institutions, um, uh, consultancy organizations, 6 critical success factors, CSF, emerge at the global scale to make consolidation, to make mergers and acquisition in the banking sector a success. So these critical success factors are one, a clear strategic rationale. Unless you are clear about the road where you want to go, obviously you will not meet with great success. Then second point is use of integration to transform businesses, adapt to shifts in consumer behavior and capture efficiencies. I think the earlier speakers in the inaugural session, Professor Gurumurthy and others also refer to need to enhance efficiencies, and one of the important instruments of enhancing efficiency could be through mergers and acquisitions in the banking sector. The third factor which has been isolated and identified is clear early decisions on integration, architecture and scope. We use forward-looking performance indicators to safeguard business continuity and momentum. Now, as we see, particularly in the last 20 years, IT has been a great growth driver, instrument of structural transformation of the banking sector. But there have been a large number of frauds, misappropriations, embezzlement by the IT route. So the issues of cyber security, of creation of firewalls, safeguarding banks from phishing attacks have also come to the prominence. It is important to manage integration quickly and seamlessly involving the system leaders. Apart from these 6 basic factors, I think 3 more important elements of the success strategy could be talent management, growth strategy, and performance management. Performance management has to be looked at in a constant real-time basis, and as and when required, mid-course corrections could be made. Now, coming to the Indian scenario, we are looking at the transforming Indian banking landscape, and this has a history of at least going back 30 years. Most of you will be able to recall that the Narasimham Committee reports 1 and 2, particularly the Narasimham Committee report 2, brought into focus the issues of size, structure, and performance of banks. Given this kind of a macroeconomic setting, banks have been consolidating to exploit core competencies, reduce operating costs, leverage large business volume. Financial sector liberalization, which has been on in India now for well over 30 years. So this also enhanced efficiency and competitiveness of Indian banks. But the issues of shrinking margin, intensified competition, stringent prudential norms, pressure on profits and profitability, and limited options for organic growth have once again brought the issues of consolidation, mergers and acquisition in the banking sector to the center state. Now, let me try to place things in a proper historical and comparative perspective. This strategic significance of banks in India emerges from the fact that more than 74% of funds are routed through banks. Banks have certainly taken a hit in the last 3-4 years. Otherwise, they are expected to, over a period of time, they have displayed strong fundamentals and resilience. At the macro level, about 60% of India's GDP is financed by bank credit, and the banking sector, across all constants of the Indian banking, they provide significant support to SMEs, agriculture, and other productive segments of the economy. Of late, the government of India and the Reserve Bank of India have been championing the cause of financial inclusion all over the country. And banks have played an increasingly important role in this cause of financial inclusion. Now, I have been part of some discussion on the banking sector at the highest level for about 20 years or so. And this issue of consolidation in the banking forum has been coming up repeatedly at various levels, whether at the level of Reserve Bank of India, Government of India, Ministry of Finance, Department of Financial Services, IBA, Indian Banking Association. We used to have annual conferences called BankCon or BECON, Bank Economist Conference, subsequently also called Bankers Conference. And on the basis of this, I think it could reasonably be maintained that some drivers of banking sector consolidation in India relate to economies of scale and scope, need to upgrade technology, rapid product commoditization with thinning spread, need to provide diverse products to both corporate and retail customers, recapitalization of banks because of the Basel norms. I would also like to refer to one important point made here, as this is largely in the nature of recapitulation. First session, one of the speakers brought out this excellent point that, and you dwelled at it for some time also, that traditionally, in the list of top 100 banks all over the world, SBI was the only Indian bank. Now, post-merger, SBI, I think, is at number 43, and some other banks are also inching their way in the top 200, 300. In this connection, I would like to draw attention to a very important publication from London called The Banker. The Banker is an annual publication published from London every year, sometime in the month of July. They have been bringing out this edition on a regular basis for the last 30 or 40 years. And it was a matter of some regret for us that traditionally, till this process gained momentum, about 3-4 years back, only one Indian bank, SBI, figured in the top 100. Other leading banks of the country, such as Bank of Baroda, Punjab National Bank, Canara Bank, Bank of India, ICICI Bank, HDFC, figured after 300 or so. Now, why do we say that the bank should go to scale? What are the attendant advantages of the bank increasing in size and muscle? The first, obviously, is the geographical spread, because it has been demonstrated across the world that diverse banks are less vulnerable to economic shocks. Similarly, the diverse loan portfolio and deposit base strengthens the bank's overall asset liability portfolio and protects it from regional and specific economic segment shocks. In this overall context of, particularly in the context of economic reforms, banking sector reforms, one strand of discussion which always comes up is the thrust on efficiency and productivity. So it is maintained that because of this thrust on consolidation in the banking sector, we could realize the benefits of economies and scale and economies of scope to better leverage assets, portfolio diversity, and asset quality. Post Basel II, what we see is that all Indian banks, particularly public sector banks, faced major problems, challenges in terms of capital requirement, capital adequacy, CRAR. So here, by going in for this consolidation route, It is supposed to help in mobilizing, meeting capital requirement and risk insulation. Uh, size brings need for more capital, but it has been largely seen that bigger banks are able to leverage size more effectively. Large banks also guards effectively against credit, market, and operational risks. Another strand of thought in this overall debate and discussion relates to greater ease of greater mobilization by the banking sector post consolidation, post mergers and acquisition, because with interest spread steadily reducing, uh, the greater size of banks helps to mobilize higher volume of business and sustain profits. Another important point is universal banking. Some of you who have been watching the banking sector, tracking the performance, would be aware that earlier we had a set of institutions called DFIs, Development Financial Institutions, in which institutions like IDBI Bank, even to a certain extent, ICICI Bank in its earlier avatar, from the time it was founded to, let us say, early 90s, they were development financial institutions. But of late, the distinction between the DFIs, development financial institutions, and the commercial banks has increasingly blurred, and there are frequent overlaps between different sectors and segments of banking, like the DFIs and the commercial banking segment. Technology could be a catalyst in removing size-related constraints in the banking sector by slowly phasing out physical forms of banking and synergizing individual entities. Competition is also an important driver of banking consolidation, because we have a situation of relatively small number of robust players vying for greater market share. There have been a large number of mergers. Even if we ignore this present phase from the last 5 years, in the past, for example, Lakshmi Commercial Bank merged with Canara Bank, Sikkim Bank with Union Bank in 99, Banaras State Bank with Bank of Baroda in 2002, Nedunangi Bank merged with PNB in 2003, Global Trust Bank merged with OBC. But here the primary driver for all these mergers, earlier mergers in the banking industry, was the precarious financial position of some of these banks and the need to protect the interests of depositors. However, there was one welcome case in which IDBI, reverse merger of IDBI Bank with IDBI, which attempted at financial strengthening. However, there were some mergers in the private sector also. For example, Centurion Bank of Punjab and HDFC Bank, ICICI Bank and Bank of Madura, and Times Bank and HDFC Bank were merged. But all these mergers in the private banking space were primarily influenced by commercial considerations. Now, let us come to some broader issues. As I said earlier, this issue of banking consolidation has been discussed and debated in different forums across diverse countries for a large number of years. So, at the global level, the evidence of the success or otherwise of the banking sector is mixed. In some cases, banking consolidation has been a great success. In some cases, it has not been so successful. So it is now increasingly realized that in moving this road to greater banking consolidation, we need to adopt proper safeguards. This is all the more important in the present context, because banking consolidation, you could have serious risk, not just for the consolidated entity, but also for the system as a whole, what we know as systemic risk. Here, some stark examples come to my mind, such as the global financial crisis of October 2008. And one hypothesis, which is repeatedly discussed, was a TBTF hypothesis, too big to fail. But as the global financial crisis and so many other crises have repeatedly thrown up, that if these kind of institutions fail, it could endanger the safety, the stability, the robustness of the entire banking and financial system in the country. When we are discussing the issue of safeguards in adopting while moving full speed ahead on the road to consolidation, it is widely agreed that there has to be compatibility. There has to be some kind of a broad agreement in terms of vision, corporate culture, and value systems. Regulatory requirements play a great deal of significance in this kind of an overall framework. So all regulatory, legal, accounting, technology, and HR issues should be sorted out pre-merger. Here, there has to be a greater focus on expert structuring, execution, together with patience, forbearance, and resilience. Post-merger, the shareholder of existing entities has to be given new shares. So there has to be, I think all of you are experts in commerce, management, so you'd be aware of the issues of complicated valuation system for transfer of shares. What is the compensation to be given? Now, brand projection is another major issue. When banks like, say, Canara Bank or Syndicate Bank, both important South-based banks, come together, so which brand is stronger, in which area it is stronger, which brand is to be projected. So these are also sensitive and complex issues. And this assumes greater significance because what we see across industries, across different geographies, is that goodwill is not automatically transferable. So this needs to be carefully monitored. There is much greater regulatory rigor in case of consolidation in the banking sector. And from the regulator's perspective, it is important to ensure that equal treatment is given to all stakeholders, particularly the shareholders. Now, let me come to my concluding remarks. Basically, whether you look at the Indian situation or you look at the issue of consolidation in the banking sector in a cross-country framework, 3 C's emerge. And these C's are the C's of competition, consolidation, and convergence. And it has been demonstrated that the pursuit of these 3 C's of consolidation, competition, and convergence require a thrust on mergers and acquisition, amalgamation in the banking sector. But here we need to address operational issues, technology platforms, NPAs, organizational culture, mindset, attitude to work, and HR. Some important work which has been done on banking consolidation in different countries. I think the speakers in the opening session also referred to some aspect, is that 3 things have to be given importance. Competition has to be based on 3 specific criteria of a regulatory prescription. Voluntary action as the owner's decision. As I said earlier, this consolidation has been tried in different countries in different times. So on the basis of this kind of a rich database that we have, maybe we can identify some important best practices and try to replicate those best practices in the case of mergers and acquisition in the Indian financial and banking landscape. Indian banks must strengthen their core competencies while exploring new vistas, achieve critical mass. This issue of critical mass is very important. I referred to the banker reports earlier, and I gave this example of State Bank of India, where it was the only bank to figure in the list of top 100 banks. And as one of the speakers in the opening session highlighted, that while one Chinese bank tops the list of global big banks. Even SBI, which is our largest bank, figures at number 43. So the issue of acquiring critical mass is very important, and banks need to substantially enhance their technological capabilities. Now, let me sound a note of caution, a discordant note to hear that sometimes in all these debates and discussions, we need to take some kind of there's a tendency to gloss over some kind of a systemic deficiencies of the Indian banking sector. But I've been writing on this for last 20 years. I wrote some pieces for Hindu Business Line, also some international conferences about 20 years back, and I've consistently argued that consolidation is not a panacea. It's not a Ramban. It will not cure all ills of the banking sector, and size has to be seen as some kind of a facilitator rather than an all-inclusive mean for efficiency. In case of consolidation, we come across a term very repeatedly. I'm very happy to note that this was highlighted in the opening inaugural session also, that here we are not looking at something like 2 plus 2 makes 4. Here we are looking at 2 plus 2 could make 22. The issue of synergies. So given the kind of experience that we have been enriched to, we have developed some kind of insight into the banking consolidation. It is now realized that mergers may not be successful unless they are market-led and synergy-driven. These two phrases are very important. In case of mergers, they have to be market-led and synergy-driven. And these synergies can take various forms, such as greater market share, higher clientele base, increased geographical spread, harnessing of technological advantage, global reach, and compliance with global benchmarks. So the basic point which I wish to drive at here is that size does matter, but size alone does not matter. Banks need to go in for mergers and acquisition, not just out of compulsion, but out of a conscious policy choice. I'm afraid there is no consensus on the optimal size of a bank branch, zonal office, or the total bank. Size has to be seen against profit, revenue, and cost functions, composition of liabilities, credit deposit ratio, quality of assets, proportion, and amount of fee income the bank is able to generate. The optimal size of a bank, it is my submission, is a function of, depends on the size of the economy, its diversity in various segments, level of financial intermediation, degree of market mechanism, and competition. Successful mergers and acquisition require basically a holistic perspective all along the line, right from the stage of screening and due diligence to all aspects of the integration process. So in India, if you recall recently, till about 2 years back, 3 years back, we had 27 banks in the public sector banking space. Now this number has drastically shrunk to 12. Going forward, there could be some more reduction in this kind of a number, but then this is a work in progress. And as I said earlier, this process has to be constantly monitored and an ongoing real-time basis. Issues of technology, issues of HR has to be addressed with a sense of urgency, and mid-course correction. Wherever we find some kind of a teething troubles, they have to be addressed with a sense of urgency. If we are able to bring all stakeholders on the same page, address all these structural and technical bottlenecks, I'm sure the mergers and acquisition in the banking sector, what is now called amalgamations in the banking sector, would be a great success. So I think Professor Vedirajan was kind enough to give me 1 hour. I'll stop here. So because this is a very controversial issue, and today you may have several queries. So I think for the next 15-20 minutes, I'd be open to any questions, any queries which you have on this subject. Thank you very much. Thank you for having me with you here this afternoon. Thank you.
Thank you, sir. Thank you. Sharma, sir. Yeah. Participants, I request the participants to clarify any queries and doubts on that particular topic. Professor Dr. Sharma sir is elaborately discussed and delivered ex tempo without any PPT. PPT will be shared at the end of the session to the respective participants. I appeal to the participants across the country, please to clarify this.
Sir, good afternoon, sir. I would like to know regarding the merger, sir.
Tell me,
See,
go ahead.
the same thing will continue, or again separation may be there, sir. Because when the economy becomes all right, people are saying that again, see, banks will be separated. What's your opinion regarding this, sir?
Thank you for a very interesting question. I do not foresee that banks will go their own ways separately. When banks have come together, they have come after a great deal of due diligence, a great deal of hard work, analysis, and all that. I think in the Indian situation, one analogy which I have used in case of mergers and acquisition repeatedly is that pre-merger, lot of spade work, lot of due diligence must be made. Otherwise, it becomes a case of marrying in haste, repenting at leisure. Once you decide to choose a partner, you should do all your due diligence prior to the marriage. Otherwise, if you marry in haste, then maybe you will develop some kind of problems post-marriage, which is not desirable. So in case of all these mergers, the Government of India, the Reserve Bank of India have ensured, for example, I'll give you the example of Canara Bank and Syndicate Bank, Bank of Baroda, and by and large, not by and large, invariably they were on the same technology platform. Their HR culture was broadly similar. So I do not foresee any possibility that banks will go their own ways separately. This has not happened in history also, but future is very uncertain. Gazing into the crystal ball and saying what will happen, not always very easy. But as things stand now, I see remote possibility. I see hardly any possibility of the banks being separated once again. Thank you.
Thank you, sir. Sir, our employees are happy with the concept, sir, because when we merge, we will have only one head. Employees are happy with the concept, sir.
Thank you again for a very interesting question. I think by and large, employees are very happy. I will tell you why. Because of the main HR issues. For example, let us say when Union Bank of India, for example, I'll give you 3 banks have come together. Andhra Bank has merged into Union Bank, Corporation Bank. So here the Honorable Minister gave a statement on the floor of the House, Parliament, both houses, and they've stuck to it that the best practices of all the 3 banks would be taken into consideration for finalizing the HR systems of the new amalgamated entity. So in certain respects, Corporation Bank may be good. In other respects, Union Bank may be good. In some other respects, Andhra Bank may be good. So what they have done is they have taken the best of all the 3 systems. And this has been the HR policy across the board. So by and large, all employees they have gained tremendously because they have gained all the best aspects of the HR policies of all the amalgamated entities. So I must agree that initially there was some apprehension, there was some concern, but then all these concerns, all these apprehensions have now been put to rest, and all employees, maybe a few exceptions, I cannot say about that, but by and large, I have interacted with large number of employees across diverse segments of the commercial banking segment, public sector banks in India, and I can confidently say with a reasonable degree of conviction that by and large employees are very happy with this new way. There are some emotional issues, so obviously there is no substitute to that kind of an emotional issues, that identity may have been lost in some cases. But as far as the pay, perks, other privileges go, all employees have stood to gain, and this is why they are more happy. Thank you.
Thank you, sir. Thank you.
Professor,
Good afternoon, sir.
Good afternoon.
Sir.
Good afternoon.
I'm Dr. S. Vijayalakshmi from Bharathasan Government College, Puducherry, sir. It was a nice, wonderful presentation, sir. Regarding the operating cost with respect to administrative cost because of merger, I think to some extent it will come down. So that is one of the criteria also. But still, will the bank reduce the charges which they are tremendously keeping on, or all the accounts like that? Because as a customer, most of the banks they are charging us. The charges has also very high. Will this merger will help us to reduce such costs?
Which charges, madam, you are saying?
No, so the charges which as a customer we are paying to the bank, for example, whatever for transactions we are doing, so my question is, because of merger, one benefit is the cost of the operating cost, administrative cost of banks will be coming down. Will that have an impact on the reduction of charges for the customers?
Madam, operating cost is likely to come down. I'll give you some example. For example, if you take for example, I was in Bangalore for 13, 14 years. If you take a MG road or Church road or some main area, in the same road you will have 2 or 3 branches of Canara Bank and syndicate banks. All the banks have merged together. So technically we are saying these branches may not be closed, but they could be relocated where there is greater potential. So maybe you can get the benefits of economies of scale and operating costs. As far as charges are concerned, so I must say that banks are not in the business of charity. Banks at the end of the day are a commercial entity. As a professor of economics, commerce, management, you must be aware that banks also have to be stand on their feet. So if you compare the charges of public sector banks to private sector banks, across the board, I have done this kind of comparison for about 20 years. I don't have the figures readily, and I can say with complete conviction and a fair degree of confidence that charges of public sector banks are no way comparable, are very modest compared to the charges they levy in private sector banks. So maybe there could be scope for some more tweaking, some more fine tuning, but by and large, I think because banks have to foot this huge expenditure. I will give you an example of these charges. For example, for all debit and credit transaction, each bank sends you an SMS. Now, for example, if you take a bank like Canara Bank, for example, we have 12 crore customers, and I'm told by our DIT people that each SMS which we send to our customers costs us 10 paise. So 10 paise may be a small amount for you, but 12 crore customers, each customer transacting maybe let us say on an average 2 times or once in a day or two. So it comes to a huge sum. So this is why we were forced to introduce a sum of for SMS charges 100 rupees per customer per year. So in these days of high inflation, I don't think any customer will mind paying 100 rupees for these kind of value-added services. Maybe there is scope for some kind of a rationalization, but all these charges need to be looked at in a comparative framework. And if you compare the charges of public sector banks with those of private sector banks, you will find that the charges of public sector banks are already at quite rock bottom levels. Thank you.
Okay, so thank you so much.
I have a question.
Yes,
I'm
ma'am.
Dr. Saraswati, Regenesis Business School, South Africa, Indian campus. My question is, considering the geography of India, we find the metropolitan branches are much lesser when compared to the other branches. So let me know how the working culture acceptance, or is there any teething problem the employees face when there is a change, and how is the banks managing this change uh, in their system?
By and large, I don't think I'm aware of position. I have been on the expert panels of so many banks also for selection of senior levels at Union Bank of India, Bank of India, and also because I've worked in Canara Bank for about 20 years, I'm also aware with law. So I can say in all confidence, we do not, so far we have not come across any major issues, maybe some localized regional level minor issues, but those will happen in any family, any group, any society. But at the systemic level, we do not foresee, there have been no such cases, and we do not foresee any such cases. You refer to the position of metro branches where they handle large volumes of business. In case of metro branches, there is a greater, I will like to highlight two aspects which would address your question. One is that the per customer volume of business is much higher than what you find in rural or semi-urban business. So here an average customer could give you a business of maybe 5 crores or 20 crores, whereas in a rural setting, a average customer maybe give you a business of only 50,000. And second is that there has been a greater thrust on using technology platforms in the bigger metro branches, so to speak. So by and large, the system has been working efficiently, and I think these digital transactions are here to stay. Digitization of banking products, thrust on financial literacy, financial education is on by various segments of the banking sector, also by the larger banking industry, IBA, Reserve Bank of India, government. So I do not foresee any kind of pressure in the larger metro or the bigger branches. Thank you.
Thank you so much, sir.
So myself, Joshi Matthew, a research scholar at College of Engineering, Trivandrum in Kerala. My question is regarding, sir, when there's mergers and acquisitions, consolidation is happening, it happens in the public sector bank. It normally increases the size of the business as well as the public sector bank. So normally on the other side, there are some amount of competition that is occurring, competitors that are in the market. Let's say the NBFCs or the other cooperative sector banks, or the small finance banks. There are other banks also. So don't you see they also will adapt the same technique to like cope up with this competition?
No, two aspects to your question. I think competition will increase, but all banks will become more nimble, more efficient to withstand these challenges of competition. For example, I will give you how competition has increased, because normally it is said that when the number of public sector banks reduced from 27 to 12, the competition will, but some of these banks were in no position to challenge bigger entities, like for example, particularly State Bank of India, also to a lesser extent, relatively bigger brothers like Punjab National Bank, Canara Bank, Bank of Baroda. Now, because the size of all these banks increasing significantly, they are in a position to challenge bigger and established players. There's a greater thrust on efficiency. For example, I've not worked in treasury, but if you have any friends working in the treasury department of banks, till about 10 years banks were in this phase of mergers and acquisition, the banking sector had not taken off in a big way. As soon as the dealer from the SBI used to enter the trading, one sentence used to go in all banks that the big brother has entered. So SBI was seen as the big brother. Other banks were not able to challenge in terms of whether mobilizing deposits or advancing loan. SBI, because of its size and muscle, could always give some concession 5 basis point, 10 basis point here or there, and they could leverage the benefits of a bigger size to push their business. So maybe they will find a greater degree of challenge among these 12 banks. Thank you.
Thank you, sir.
And Sarvasa, I have basic question. Basic. Hello.
Yes, sir.
So you are in Canara Bank. You are working a very precious position for chief economist and other middle manager of Canara Bank. So the Canara Bank is merged by Syndicate Bank. Is there any parameter to tracking for that merging activities? Are there any efficiency or inefficiency or poor management whether this bank is merged with the Canara Bank, or it may be for a healthy purpose of the Canara Bank, or it may be some other reasons, maybe for political reasons, maybe. What do you want to say this?
No, sir, I don't think the basic justification of these mergers or amalgamation has to be seen in economic terms. They are standard parameters, they are standard benchmarks for judging the efficiency and productivity of bank. For example, the cost income ratio should not exceed 40%. The NIM, net interest margin, should be above 3. So what is the level of technological automation? Since, as you're aware, all these mergers have happened very recently, they have been effective only from 1st April. So maybe it takes about 2 years, 1.5 years. So these are still early days. So maybe after some time, you can do some kind of an assessment whether we are on the right track. But going by anecdotal evidence, the kind of debates and discussions which I have with my banker friends, I find that we are on the right track, and gradually over a period of time, this will lead to significant improvement in terms of products, in terms of efficiency, in terms of profits and profitability. Thank you.
Yeah. Thank you, sir. Thank you. Participants, any clarifications, any queries that Sharma sir is ready to? Australian team. Shiba Shetty.
Sir?
Shiba Shetty. Focus vote of thanks, sir. Sharma sir.
Thank you, sir. Thank you for your thoughtful, provoking session and also for clearing queries raised by the participants.
Hello.
Yes, sir.
Australia. Yeah.
So if there are no queries, we can close it because I have another meeting at 1 o'clock, sir.
Thank you very much, sir, for your valuable and precious time for sharing this for inaugural session of the second speaker. In a crisp manner, you have to pinpoint this how this banking sector to merged, how this banking sector to acquired, then for takeover, all these things for consolidation and consideration for that, through this restructuring for core competency, as well as for the, what is say that competitive advantages. So on behalf of this department, on my own behalf, I wholeheartedly thank you, sir, for sharing your valuable precious and spending time. Thank you very much, sir. Thank you.
Thank you very much, sir. Great pleasure and privilege being with all of you here. Thank you very much, sir.
Yeah, thank you.
Thank you, sir.
Dear participants, you have break, that is lunch time. You have to assemble here at 2:30 p.m. for second session. The second session is chaired by Professor P. Saravanan from Indian Institute of Management, Tiruchirappalli. Thank you. So we'll meet again. We have to assemble 2:30 p.m. Thank you very much.
As Professor said, now it's time for lunch break. We will get together at 2:30 for the next session with this same portal.
Record பண்ணுங்க. க்ளோஸ் பண்ணாதீங்க. ரெக்கார்ட் பண்ணுங்க. அப்படியே அலையில இருக்கணும்.